This is part 3 of the Rolling Retained Earnings series. I have 2 previously posted videos I'd like for you to check out before watching this one, but let's get into it. Brief recap. Rolling retained earnings means your retained earnings in the current year, the balance in retained earnings, rolls from the prior period. So let's assume this is the original trial balance, and we had the retained earnings balance, the income here, cost and expenses, that's listed here, and the credit is a negative and debits is positive. That means our expected balance in retained earnings, what should be in retained earnings, is $440,000. Clearly it's not. Now what that means is something changed in the prior year, and you need to identify what those changes are. We've got a nice formula here to do that. For whatever reason, somebody went in and deleted some transactions or added some transactions, and that's throwing everything off. So the way to roll retained earnings to make sure that this amount here, the $440,000, agrees to this, is to record a journal entry to reestablish those balances. So this was the most recent one with changes made after the fact, and we wanted to restore it to these balances. So accounts receivable in the new trial balance decreased. So what we would have to do is add back that balance to accounts receivable to get to this $21,000 amount. Accounts payable, there was a posting of an invoice that increased accounts payable from $13,000 to $21,000 for $8,000. We want to decrease it back from the $21,000 to $13,000. So when I typically roll retained earnings, I ignore the income statement. So I just pull up the balance sheet and compare balance sheet accounts, because ultimately anything that was in the income statement, the net income difference, is going to be plugged to retained earnings. So in this case, we have $5,000 that we need to add back to the trial balance. So that's a credit of $5,000 to retained earnings. Cost of sales increased by $20,000. Well, we need to decrease it, so that's a credit of $20,000. So instead of going to the income statement accounts, I start off with a credit to retained earnings. I know I need to plug in $25,000 to get this $444,000 in the current year. That credit of balance of $415,000 plus $25,000 gives me my expected balance. Now, the next step is I record the differences, the changes to the other balance sheet accounts. You can do this either way, but I think this helps for demonstration purposes and to leave a trail of breadcrumbs. So I just restore those balances. The accounts receivable was changed to $16,000. I am going to debit it back to the $21,000 amount. Accounts payable increased by $8,000. I'm going to debit it to go back to the $13,000. Same with payroll liabilities. I'm going to debit it to decrease. So now I have an amount that should agree in my retained earnings. Just for the sake of this example, I'll double check as we credit $25,000. Ignore these sums. Obviously, I need to make the other adjustments, but $440,000 here, $440,000 there. We agree. Okay, so we know we've got the retained earnings piece right. Now, what do we do with all these other balances we added to the balance sheet account? Well, it's likely we'll need to get rid of them because it's already ran its course through the balance sheet. Cash was transacted, refunds, whatever it is, already happened. So we need to eliminate those balances because they could very well be throwing off our subledgers. So the way to do that is to record offsets. All these accounts were debited. Now you're going to credit them, and move the activity to the income statement. So what you see happening here is all of these transactions were recorded in 2021. We're moving it into 2022. We're not completely eliminating it with this retained earnings journal entry. We're just shifting the period so it looks like we picked up where we left off last year. Now, that's assuming the amounts aren't significant, so it's not going to be that big of a deal. If this was a really big balance, we would have to show it as a prior period adjustment. There was a mistake there, and we needed to record either revenue or expenses. That throws things off. But if it's a small enough amount, all you're doing is picking it up from 1 year because we're carving it out from the most recent trial balance and moving it into the current period. So we're eliminating all of these accounts we set up to make retained earnings roll, and we're moving it to the income statement. So sales will be decreasing, right, because it's a debit by 5,000. And we said cost of sales will be increasing by 20,000 because we're adding in that cost. And then let's go ahead and do this 25,000 credit to make retained earnings roll. Now we have the whole balancing trial balance. The journal entry works. So this is a very simplified approach to it. Again, you're just picking up the pieces and moving it in to the current period. I hope that all made sense. If not, please leave a comment below. Otherwise, thanks for tuning in, and I'll see you in the next lesson.